Power and Energy Midcaps, Quality Behind the Momentum, in May 2026, by Value and Momentum Portfolio. Today we're looking at Power and Energy Midcaps, the smaller and mid-sized companies in the sector, names worth somewhere between $1 and $20 billion. We ran a screen across the S&P 1500, and we filtered for two things at the same time: quality and momentum. On the quality side, we wanted companies that turn more than 30% of their earnings into real free cash flow, with returns on equity trending up through the end of the decade. On the momentum side, we wanted to see analysts raising their earnings estimates and lifting their price targets. The fundamental data runs through the first quarter of 2026. The analyst ratings are from March through May, and the earnings we looked at cover this past November through May. Quick disclaimer before we go. This is for information only. It's not investment advice, and it's not a recommendation to buy or sell anything. The setup. Let me set the scene because the backdrop matters here. Energy security has been repriced. Back in March, the Iran conflict shut the Strait of Hormuz, and that changed how the market thinks about supply. At the same time, the Middle East is starting a new cycle of rebuilding capacity, and running right alongside all of that is a second story that has nothing to do with oil: electrification. Demand for power infrastructure is pulling equipment makers into the picture too. So this isn't really a bet on the oil price. It's a search for the operators that have earned the right to keep compounding, whatever the cycle does. The core idea. Here's the thing we keep coming back to. The market still treats this corner of the world like it's cyclical and burns cash. But a handful of these companies are doing the opposite. They're generating real free cash flow. They're paying down debt, and they're handing money back to shareholders. You can see it in the price targets. Weatherford's target nearly doubled in about 3 months. It went from $83 to $156. Powell's more than doubled, from $160 to $360. That tells you something. When targets move like that, analysts aren't predicting the future. They're catching up to results that already happened. And when the estimates are behind reality, that catch-up is what drives the stock. So let's go through the names. I'll group them into 3 buckets: the ones we'd rank first, the speculative ones, and the ones we'd avoid. Weatherford, WFRD, high conviction. Start with Weatherford. This is the name we'd put first. It's an oilfield services company, about a $5.6 billion market cap. Returns on equity are climbing from 5.6% to 8.1%. Net debt to EBITDA sits at 1.78 times, and it's falling. Management actually reported net leverage below 0.5 times on the call. That's a different way of measuring it, but it points the same direction. Trailing free cash flow is $290 million, and the earnings beats are getting bigger, up 31.7%, then up 43.3% the next quarter. Most analysts rated a buy. What does the company do? It works in about 75 countries across 3 segments, and around 85% of its revenue comes from outside the U.S. It competes with the big 3, SLB, Halliburton, and Baker Hughes. And it specializes in things like managed pressure drilling, artificial lift, and digital and subsea work. Now, the first quarter call on April 22nd was dominated by the Strait of Hormuz. Revenue was $1.152 billion, down 3% from a year ago. And most of that drop was selling off the Argentina business. The EBITDA margin was 20.2%. Adjusted free cash flow came in at $85 million, which is a 36.5% conversion rate, up from 26.1% a year earlier. Management said the conflict would cost them somewhere between $30 and $50 million in the first half, and they guided second quarter revenue to a range of $1.02 to $1.11 billion. For the full year, they're guiding revenue of $4.5 to $4.95 billion and EBITDA between $945 million and $1.075 billion. The free cash flow conversion target is the mid-40s this year, and 50% over the cycle. On the balance sheet, they're sitting on about $1.05 billion in cash. They've returned $330 million to shareholders since the program started, and they raised the dividend 10%. They're also moving their legal home from Ireland to Texas for tax and capital reasons. The CEO, Salagram, said this is the most constructive outlook the company has seen since late 2023. He pointed to repriced energy security, the Middle East rebuild, and an offshore deepwater pipeline. More than 30 drill ships to equip. And there's a clear list of second-half contract startups: the UAE, Brazil, Argentina, Australia, Indonesia, and Egypt. So here's the bottom line on Weatherford. The earnings momentum is accelerating, the balance sheet is in good shape, but there's a live risk in the second quarter: the Strait. The whole story assumes a strong second-half recovery once the Strait normalizes. That's the bet you're making. Ovintiv, OVV, high conviction. Next, Ovintiv, about 9.9 billion. This is the name with the broadest analyst backing, close to a wall of buy ratings. Returns on equity are positive after a portfolio reset. Net debt to EBITDA is 3.9 times today, heading toward about 2.5 once the Anadarko sale closes. Trailing free cash flow is $733 million. The beats run 39%, then 13%, and 13% the quarter before that. The target moved from $49 to $75. It's a pure North American exploration and production company, and it's concentrated in just two basins now. The Permian in Texas, about 120,000 barrels of oil a day, and the Montney in Alberta and BC, about 85,000 barrels a day of oil and natural gas liquids, plus 1.35 billion cubic feet of gas a day. They sold the Winta asset for $1.9 billion in 2025. They're selling Anadarko for $3.0 billion with a second quarter close. And they bought New Vista in the Montney for $2.8 billion back in February. Proved reserves stand at 2,325 million barrels of oil equivalent. They added 268 million last year, and they run the whole thing on about 1,465 employees. The full-year call was February 24th, and it marked the end of a multi-year transformation. Free cash flow for 2025 topped $1.6 billion. Fourth quarter cash flow per share was 3.81, about 10% above what analysts expected, on $508 million of free cash flow in the quarter. After Anadarko, pro forma net debt lands near $3.6 billion, at or below their $4 billion target. On the debt itself, they carry $4.9 billion in long-term notes and $351 million in commercial paper, and paying some of that down saves them roughly $65 million a year in interest. On capital returns, they've committed to giving back at least 75% of free cash flow in 2026, with a long-term range of 50 to 100%, and they've got a new $3 billion buyback. Production guidance for the year is 620 to 645,000 barrels of oil equivalent a day, about 209,000 of that oil and condensate, on roughly $2.3 billion in capital. And their well costs keep dropping, under $600 a foot in the Permian, under $500 in the Montney, each about $25 a foot cheaper than last year. On the technology side, they're using surfactants that lift oil recovery 9% across 300 Permian wells, plus AI-driven drilling. The CEO, McCracken, leaned on inventory depth. More than 3,200 premium drilling locations added since 2023 at about $1.4 million each. And he called the buyback the highest return use of cash right now. They're in maintenance mode, not chasing growth. So the bottom line on Ovintiv, it's a de-risked transformation story with a big buyback about to kick in. It's more tied to oil and gas prices than Weatherford is, but it's been repositioned. Magnolia, MGY, high conviction. Then there's Magnolia, about $5.9 billion. The story here is low debt. Returns on equity are moving from 3.4% to 4.9%. Net debt to EBITDA is 1.1 times. Basically net cash. Trailing free cash flow is $86.5 million. The earnings beats are small, 2.8%, then 3.85%. Targets are rising, but it's mixed, and analysts are split between hold and buy. This one earns its spot on quality, not momentum. Steady cash, low debt, good downside protection. The beats are small, and the coverage is split, so it's really about durability, not a fast re-rating. It's the quietest of the four, and that's by design. Powell, P-O-W-L, high conviction with a caveat, and then Powell, about 6.6 billion. This is the pure power infrastructure name. Returns on equity are steady, around 6 to 8%. It's in a net cash position. Trailing free cash flow is 72 million. The screen shows two earnings beats, 12.8% and 17.7%. The target more than doubled from 160 to 360, and JP Morgan just started coverage at buy. Now I have to flag something here, because it matters. There's a contradiction in our own notes. The screen logs two earnings beats, but the closing note says Powell missed last quarter. Those two things don't agree. So before anyone sizes a position, we need to reconcile that against the next report. I'd rather call it out than paper over it. So Powell still clears the bars. Net cash, steady returns, a fresh buy rating, strong target momentum. And we're keeping it in the high conviction bucket. But that recent quarter question is an open item to watch. The speculative names. Now a different bucket, speculative. These have strong momentum, but something in the fundamentals holds them back. First, Darling Ingredients. Earnings were up 618% year over year. The targets are all buys and they're rising. But net debt to EBITDA is 15.7 times. That's the disqualifier. The balance sheet is the only thing keeping it off the main list. Until that leverage comes down, it's a momentum trade, not a quality holding. Next, SM Energy. They beat by 33.6% in the first quarter, and Raymond James upgraded them to buy with a $55 target against about 30 today. But leverage is 5.5 times, and returns on equity are shrinking, so it's speculative. If more analysts pile in, the target chase can work. The fundamentals just aren't there yet. And then Murphy Oil. Long history of beating earnings. But return on equity is just 0.23%, and analysts mostly say hold. This is the weakest of the group. The beats are real, but near zero returns and lukewarm coverage mean it's tactical at best. The names to avoid. Three more we screened out. RPC, near zero returns, thin margins, and barely any analyst coverage. Nothing here supports it. UGI missed earnings 3 quarters in a row, leverage of 6.8 times, and it got downgraded. The earnings trend and the balance sheet both point the wrong way. And Sunrun, net debt to EBITDA of 97 times, analysts slashing their targets, and cash flow that's all over the place. That's the easiest one to exclude. How to think about the risk. Let me step back and frame the risk in 2 layers. There's top-down risk and there's company-specific risk. Top-down, the macro stuff. The big near-term ones are the oil and gas price and Middle East geopolitics. The Strait of Hormuz is the live one, and it's hitting Weatherford right now. 30 to 50 million in the first half. The slower-moving macro risks are tariffs and supply chains. Canadian rules in the Montney. There's royalty reform coming in 2027. And the longer-term pressure from the energy transition, company-specific. The sharp risks here are leverage. Darling at 15.7 times, Sunrun at 97, UGI with its misses and 6.8 times, SM at 5.5 with shrinking returns. The quieter company-specific stuff. Weatherford has around 24% of its receivables tied to Mexico, plus covenants on 1.5 billion of long-term debt. Ovintiv has the Anadarko deal to close, hedges that cap its upside, and currency exposure in Canada. And Murphy's problem is simply weak returns. Here's the pattern, and it's the whole point. For the names we like, the risk is mostly the environment, prices and geopolitics, while the company-specific stuff is being managed. For the names we don't like, the risk is the company itself, leverage and weak returns, and a calmer backdrop won't fix that. Bottom line, so to wrap up, Weatherford is the name we'd put first. Accelerating beats, a balance sheet that delevered fast, and analysts chasing the target higher. The one thing to watch is the Strait of Hormuz in the second quarter. Ovintiv is the cleaner, de-risked story with a big buyback about to start, more exposed to oil and gas prices, but reposition. Magnolia is the low-debt, steady cash name, and Powell is the power infrastructure play with that one open question about last quarter. The bigger idea, In this part of the market, the quality has improved faster than the price has. That's where we're focused.